Hola, Mark.
Am I part of the cold opening?
No, you're not part of the cold opening. We didn't even do a cold opening. We just jumped right in.
We're jumping right into it?
Yeah.
I guess that's the definition of it.
So, how are you, by the way? And I meant to say that, and I said this before, your shelves are very empty.
They're sadly very empty. Down to my last handful of bottles here.
I don't know. I don't know what to think, Mark.
You thought I was never coming back.
I kind of did. I thought there's no way he's coming back. That's what I thought.
I can't say I've had my fill of French wine, but I have certainly gotten a good taste.
I got it. I love it. So you're coming back in a week?
Coming back in a week. Going to be trading the market at the regular hours. No more staying up till 10 o'clock at night to bang the close. You know, it's back to regular trading life.
I got you. All right. Well, anything new in the world of low volatility options trading? Are we smashing everything?
Vol just keeps crushing down. I mean, we ticked a little bit ahead of CPI number today. But yeah, I mean, after that low reading, inflation coming in a little cooler than expected. Yeah, I'm definitely just seeing vol
get mushed. Yeah,
getting mushed.
I know, and it's the
getting flatter too.
Right, it's the I'm in the middle of summer kind of doldrums. Although our volume over at the trade years has been pretty good. It's above average when the industry is below. So I can't complain about that. I think that's good news for us.
No, that's great. I mean, the OCC has been doing decent volume, but like you say, it's a little below, what the last 12 months have been.
Right. Well, here's what I got for you today. I want your opinions. First things we're going to do is you and Jason did a fake trade together. So let's have a quick look at that. See how that's doing. Okay. Tell me what you think. We're gonna rip on Jason today. He's not here. All right. Here's the trade. Right. So what I have is we have the spider. You are long the spider 439 call in September, and you are short the spider 439 call in July 21st expiration. It's a 1-to-1 spread. It's a calendar or time spread. You are up $108 on a one lot.
Woo.
So that's pretty good.
That's not bad,
right?
Yeah. I mean, direction certainly helped me here.
Yeah, it did. You're right. Right. So this is now a short delta spread. I mean, just barely. See it over here in the corner?
Yep.
Any comments on this? What do you do with this guy right now? Would you say? So you're up. What are you up? $1? I don't know. $1.08. Is that right? I think.
Yep. Paid like $7 for this, I think.
Yeah, 704 is what it says.
704.
So you're up 15.35% or 34% thereabouts. Right.
So I think an interesting question, right? Like we're obviously going to roll this trade. And I think when it comes down to rolls, it's all about timing. And so what I want to think about here, obviously don't have Jason to trade with right today, but to the extent that I would be looking at this to trade, I'm going to be looking at maybe how much extrinsic is left in that 439 call.
Gotcha.
We're in the money, right? SPY's trading like 443, something like that.
Yeah, that's right. Here we are. Here I'm on the screen. So 446 is what I see.
446. Okay.
Yeah. Okay. So here's your spread right here. Right.
So we're like $7 in the money.
That's right. Yep. So now you've got it. So are you gonna propose rolling? You're gonna buy this short in and roll it out to what, the next weekly? Do you, or after 21, or do you roll it out even farther?
Important decision. I think if I'm going to buy that in, I want to see very little extrinsic value, right? Like I want that to be mostly just deltas that I'm buying in.
Okay.
And I think I tend to like rolling like up and out. So up in strike price, out in term. As far as the question of like how far out in term, I've said it before, but my sweet spot on shorts like this tends to be like the 30-day range. So when I'm thinking about this trade, I'm thinking I'm buying September. You know, we did it almost a month ago.
Yep.
I was buying September and sold July when it was about a month out. I think we did it like June 20 something.
Yep.
So you get a month in July. Maybe I get a month to sell again in August, and maybe I get a third leg in September.
Okay.
So I tend to try and price sort of my strikes based on what my cash flow expectations are too.
Got it. Okay. So I like that. Here's what I have. So you have, this is Spider now on the screen. Can you see it?
Yep.
We don't get a drawing tool with this StreamYard thing. We need that. Mark. Okay, so here's the 439. It's down here. As you said, it's in the money. I'm circling it with my mouse. Can you see that?
Yep. And it looks like those puts are trading like 67, 68 cents.
There's a little juice left. There's a little life left in those. But don't forget,
16 delta.
Yeah, we've erased all these strikes because we're already short here. Now, so you're saying you're going to jump out, you like 30 days, but we have so many choices. Why don't we just keep collecting premium by rolling out and up every week? Does that make any sense?
I think it really depends, what you're looking for. Obviously you're going to collect more premium. Like that's just, the way the theta decay function works is, you're going to be sort of on that steep end of the curve, always collecting a little bit as they just drop off to zero.
Right.
What you risk though, and this is the balancing act, right? Is are you going to get chopped up here? Are you going to get chopped up in your roll that it's going to go through and you're going to roll up and out and then it's going to go back down and you're going to, that's where you get risk. It's almost like it's managing a short gamma question because you are short gamma here.
Right. So here's what I'm thinking. I mean, I'm going to ask this. I want to get your opinion. If we roll this up and out, it's going to give us a shorter delta, a less of a short delta if you roll it up. So we're going to be very much long deltas. We've already made a directional bet at that point, right?
Correct. That's a really good way of putting it because that's that effect of you getting less short deltas is effectively like buying in higher.
That's right.
So you're now sort of like locking in this delta bet rather than the 439 was slightly out of the money, I believe, when we made the trade.
That's right. So what about this idea? What about, it almost sounds like maybe we want to reposition this whole spread if we like it, so that not only do we roll the short up and, out, but we also do something with this long. Maybe we just roll the long up and then we reposition it.
That's, I think, a really interesting point because ultimately, like the thesis behind this trade, which is always good to come back to your thesis. Just because you made money doesn't necessarily mean, you're doing the right thing. So why do we put this on? Do we want to continue leaning into like a long delta play? Maybe like that could be a thing that you believe.
Yep.
But I think to the point of what our thesis was originally, it was a time spread question. It was a vol question.
Yep.
That we were talking about the contango that exists in the market where near-term vol is low. Like the July vol at the time was trading lower than the September vol.
Yep.
And Jason liked that spread, selling higher vol to buy lower vol.
Yep.
Because he wants to be long gamma because he thinks something's going to happen in the medium term. My point is that I want to finance that long-term vol by selling the short-term vol and getting short it because I think from a dollars and cents perspective, it makes, I want to collect that premium on even though it's nominally lower vol.
Right. Right.
So I like your idea, coming back to it, of rolling both up to another at the money spread.
So we got to do an out and up and we got to do an up.
Outer and upper and up and out.
Yeah, right. So no, you wouldn't roll your long out it further, would you?
That's right. Yeah, you're right. We want out and up and up.
Yeah,
exactly what you said. Yep.
So we would do something like this July is what we have on. So here's what we would do. We go like this. You're not seeing the screen. Hold on. Let me go back. Okay. Can you see this? So we're at the 439. So we would buy this 439 in the shorter term, the July expiration, right? And then we're going to do a four-way. We're going to roll this out. How far out are we going to go?
Do you
want to buy
something to talk about if we only do it 2 weeks from now?
Yeah. So like up July 25th.
Yeah, that's a decent.
So where do we roll at the money, or do we go a little in the money?
I like at the money in some ways. When it comes to like equities pricing, I'm a fair market guy,
Sure.
right?
Okay.
Efficient markets guy, I should say. So at the money.
Okay. So I did that. So we get a little debit there though, right? Because we're buying in our short. That's a bigger daddy. But watch what happens here. So now we got to go find September, and it was the 15th, I believe. If I'm not mistaken. So that's here, and we were long the 439. So we're going to sell this guy here, 439 that we're long, and we're going to roll that. Are we rolling that back to the at the money? Just be left with a time spread again, or do we want to make a diagonal out of this baby?
I like the rolling this up to at the money again. So we're 446 in both.
So there we go. So that's the whole spread, and we're doing this for a 43-cent credit. That whole package.
Correct.
That whole package. Interesting.
And this leaves us slightly long delta again.
It leaves us
long about 30 deltas.
Yeah, long about 30 deltas, and that's on a one lot, 30 deltas. So there it is.
Which is approximately how much, and whereas currently we're short deltas.
That's right. So if you look at your trade now, let's go to strategies, and you look at your delta, you're short 36 deltas on the one lot now, which makes sense, right? Because it's in the money. This thing's in the money now.
Right. My best case scenario is this goes right back and pins at 439 right now.
Yep, and then you can see that from this graph right here. There's
exactly.
Right there. There's your high point peak right there. So what we're going to do in strategies when Jason's back is we're going to decide to make this trade. We're actually going to put all the components in here. The strategy tracker is going to keep track of these two adjustments in addition to closing these out. So we'll make a closing trade here. You're going to bank $108 ish, and then we're going to do the new trade. It'll keep a running total of everything we do on this thing. So we can kind of
nice. It's a very cool feature.
Yeah, it's a journaling thing. So we can keep track of this with every little decision we make along the way in our pretend account. Isn't that cool?
It's very cool.
All right, cool. One more thing. Let's talk about
we got another trade, don't we?
We have another trade. It's called the exploding bull spread. Okay.
Now, this was a new one to me. This is
so it's new to me too. I got this from one of my colleagues. His name's Eric. He talks about this a lot. This is a trade he likes to do. So what it is, and we're gonna break it down. Let's see if we can do that quickly. So what it is let's go back. Where did I have that? Was that an Apple? Sorry. Apple it is. Let me go back to Apple. AAPL for Apple. Okay. So it is, let me see where I put this. So we did this in 8 of 18. Okay. So let me go there in Apple. 8 is the wonderful month of August. It's the hottest month. Here it is, right here. Yep. So we had this spread on here. Watch this. And we got one of these guys. There it is. Okay. We have a put credit spread, right? 2 times to purchasing the one call. And we do this for a credit. It says 82 cents credit. Okay. And this is what that trade looks like. So
and we've got the short leg of the put spreads about $5 out of the money, and the long leg of the call is about $5 out of the money too.
Yeah, and we could tinker with this if we want. So obviously, let's break this down and see what happens if we move these around a little bit. So what we have here is you can see the last trade is up here, right? So obviously, there's a point that's a break even because the put credit spread, if it's out of the money, we collect that credit spread twice. And we lose we might lose on our long call. So this whole line represents that spot where we're just doing wonderful. But then the 195 call, again, this is expiration, this yellow graph. At 195, we start exploding to the upside. And that's the explosion part of the exploding bull spread. It's kind of a cool spread. And I totally get why we did it for a credit. It's so that if we linger around this price and drift down, we still make money on this trade, right? We just
you have about $5 a buffer. You got 2% to the downside. So
you got 2% to the downside. Now you made an observation pre-show. Look at the downside though. It's $15. Is that about $15? Yeah, Actually, $20. So $20 ish. No, that's not right. You're right. $15.
No, it's like 15. Yeah.
Yeah, you lose about $2,000 down here, right? So, what do we think about that? So we're losing 2,000. We have unlimited upside. I get it, but it takes a little while for us to get to the good stuff. $5 or so. Is that right?
Correct. And so, like, I think, this, to wax philosophical for a minute, this type of spread is exactly why options are so beautiful, in that there are so many different ways you can play it. Because fundamentally, this is a bull spread, right? Like, I didn't see how many deltas you're actually long here, but you're betting Apple's going up, right? Like, you're selling downside to buy that upside. It looks a lot like a stock position that has a protected put on almost in some ways, right? Like, you sort of have like an equity right up into the right chart with a protective put off on the bottom with a little bit of a flat area in the middle. But anyway, point being, this is broadly a bull spread.
Right.
You're financing that by taking the risk of it going down, by selling those put spreads.
Yep.
Zero cash outlay, or effectively zero cash outlay, maybe a very small credit to your point.
Yep.
But that credit's relatively small compared to the gains you can potentially get, or loss that you're taking on the short side. I personally so if you want a zero cash outlay or close to flat cash outlay, this is a beautiful way to get long something and get paid if it doesn't really do anything, or not lose anything if it doesn't do anything.
Sure. And the real point too is, I want to emphasize this, is you as a trader of this spread, you are technically bullish on the stock.
Very bullish.
But you probably have a little bit of fuzziness on when bullishness is going to happen. So you finance this by putting a little premium out there, right?
Exactly. And you're bullish, like you're better than just long the stock or long 70 deltas, because you do have that neutral area where if stock goes up or down 3%, you're basically fine. It's like you did nothing.
Yep. And you still collect your 82 cents.
So it's not nothing. If you do that, every week of the year, that's a good gig. But I personally and so this is great. Like I said, if you want that zero cost kind of setup.
Yep.
Personally, I like to get into my trades maybe with a little bit more of a debit if I'm bullish, or I might play with those strikes a little bit, such that either I sell something further out of the money, and in terms of the put spread, so I have a little less risk, nearby. Maybe I tighten up the legs of those. That's the direction, for my personal preference, I would tweak it.
Now have a look at this one over here. This is a comparative two graphs. So the green graph is spread number 2, and the yellow graph is the one we just talked about. So the yellow graph is the 75-85 put credit spread twice, with the 195 call once that we're long. Okay, that's the yellow graph. So you can notice it's steeper down on the downside, so you lose a little bit more money, and it's you gain more quickly to the upside. Now the one beneath it, I think, is the one you advocate for being more interesting. Is we've rolled down the call spread, so I made it the 170-180 put spread. I'm sorry, the put spread, and we rolled up our long call to the 200. So you can see that kind of flattens this graph to the downside, the green one, and it doesn't give us as steep of a reward to the upside, from the get-go. So that's you kind of like that green one a little better, I think.
And in some ways, it depends on the intent. And to your point earlier about when do you think this is going to happen? Something like the green one is going to give you a broad. You want to show this at expiration because it's going to give you a much wider range where you're flat P&L.
Yeah. So let me see if I
like this idea of, hey, I think Apple might do something, and if it does, it's really going to move. But if it doesn't, I sort of want to be kind of protected around, this wishy-washy area.
Here's expiration. Okay. Again, green graph is the second one. I think the one that you like a little better. Look at that range, left and right. And then the yellow one is the one that we originally spoke about. So yellow goes from here, which is about 185-ish, little underneath that, up to 195 is kind of your where you break, you make a little bit of money. Whereas
yeah.
this one gives you much more kind of play up and down, but you don't start making it for a little bit longer, the exploding part.
Right. If you want to be more, if you want to get paid sooner, you got to take more risk on the downside.
Yep. Or you eat into that credit to the upside. So we could still do this trade by moving that 200 call down to 195 like we had before. So I'll do that real quick. Okay, and let's go back to that expiration, which is it here? Yeah. Okay. So now look at it. So the green graph is the second one again, right? So we got this nice long space here still, but now we catch up with the upside. We still have a small credit, but notice, it's not nearly as big anymore, right?
It's why that yellow curve is shifted slightly above.
Yep.
At each of the break-even points.
That's right.
Each of the kinks in the curve.
Yep. So let me see if I can get this here. Yeah, here it is right here. Okay. And it's, I got to move this down. Hang on. Let me do this. So I said 80, 70, right? No, that's a 70. Sorry. I'm moving this to the 70, and this is the new spread. Moving this to the 80. I just want to see the credit for this thing. Oh, see, it's a debit now. At the 195, it's a debit.
Okay, you're paying a little. You're paying 22 cents?
Yeah, I'm paying 82 cents there. So that's that's a big difference. I got to move this guy up. Now we get back to our credits. So that's what we have to do. We don't have a choice.
But in the grand scheme of things, that 82-cent debit isn't that big.
No,
you're talking $10 spreads. You're talking
right
relative to what you're risking, for example, with that short put spread.
Yep. Okay. Well, I don't know. I think I found the spread interesting, to say the least. So I wanted to bring it. It's called the exploding bull put spread. So gives you a little, you kind of play with the ranges a little bit based on where you put your put spread and where you buy your call. Try to get a credit out of this of something reasonable, not a penny, but it's some kind of credit. So that kind of protects you for that 2-3%, up and down. And then you have that exploding bull. It's almost like a seagull.
You stole what I was just going to say. I was going to say this is an upside down seagull.
It's an upside down seagull.
Just realizing the same thing.
Yeah, right.
Instead of you're long the call and short the put spread, instead of short the put spread, or instead of long the put spread, short the call.
Right. Yeah. It's an upside down seagull.
It's an upside down seagull.
Okay. Another bird.
I knew there had to be a bird name for this.
An upside down seagull. All right, I got to remember that. All right, good. So I kind of like that trade. I'm going to think about it. I'm going to put it on and kind of play with it a little bit, see what happens. So that's pretty cool.
In some ways, it gives you a similar. It's not the exact same profile, but it's a way. Like the seagull makes a lot of sense to me as an overwrite on an equity, like an overlay on an equity strategy. That's right. Where the seagull, as the downside protection, short the upside against your, the equity holdings.
Right.
This is an options only structure that gives you a similar-ish payout profile.
Right.
Where you get to participate in some of the upside, you're protected on the downside, but it's an option only structure. There's no equity involved.
Right. So this is, I wonder what the margin is on this. Do we know?
Sorry, do we know what?
Yeah, my margin changes by $2,000 on this trade. Interesting. That's about my max loss, right?
Yeah, exactly, because you're short that put spread. That's where all that margin is coming from. Yeah. And any credit you receive from selling that, you immediately just have as long options.
Yeah, right. Yeah, I kind of like it. It's interesting. I got to think about it. I want to think of a little wrinkle on this one. Because now I'm starting to think, what if I did an exploding put spread with two wings, the call and a put somehow?
Okay. I was going to say the other dimension you could take this across is time.
Yes.
So you could potentially do a long-term call.
Yeah.
Like depending on what cross-term skew looks like, you might want to buy a long-term call and sell near-term put spreads against this.
Right. Right.
Then you benefit from both theta and skew.
Yep. Yep. All right.
That's
One more thing. We're going to look at this one more time. You tell me what I did. Look at this.
Are you long? You're almost long another put down way down at the 160
I
level.
Put at the 160 level. Still, it's only 32 cents. Remember my old credit, 82. So I ate into 82 by 32 cents, right? So now what I have is, I don't have much room here to this downside. It's 184.76 as opposed to 184.59. So I've only pushed that up a little bit. And now my max loss is down the same number, but then I kick it up above 160. I don't think that did much for me.
I think, what if you did, instead of selling a 2x2 put spread, what if you just did a 1x2? It's going to change you're going to take on a little more downside risk, but you might get a bigger credit, or you will get a bigger credit.
I don't understand that. So what am I doing?
Sell 2 to buy 1. Reduce your 175 to only be long 1.
Oh, but then, and then I gotcha. And then
remove the 160 and sell the 185, 175, 2x1.
Yeah, but then I'm short a unit, right?
Then you are short a unit. Right?
Yeah, that's going to give you got to have a certain option level for that.
Yeah, you're right. And you'd need your margin would be
way higher.
The 1 unit on, you'd be 17 grand of margin.
Yeah, that'd be scary. Yeah. So. All right. Well, good. This is good stuff. I like it. So I like these teasers like this. Someone brought this to me. I thought we'd break it down on our show here. So glad we did it.
Yeah, it's a good spread. I definitely, just in the 2x1, that's a nice way to be lazily bullish something.
That's right. That's exactly right. Options are beautiful, aren't they?
They really are.
All right. Good deal. All right, Mark. We'll see you next week. You might be back in New York by then.
I will be. I'll be coming to you from Brooklyn next week.
I love it. All right. Talk to you then. Have a great rest of the week and weekend.
All right. Happy trading, everyone.
Happy trading.